Dang, it's April Fool's Day tomorrow. We're winding down rapidly. Um, this is, in fact, this is the last week that you guys will have an assignment, so we'll kind of go over that. And like I said, in the weeks to come, I'll probably go over the contents of the chapter. Sorry, kind of an old boring, go through the PowerPoint lecture type of thing. Hopefully, help you with the quizzes, but also intersperse it with information that might help you with your Project 2. And today we'll talk a little bit about Project 2 after we've gone over the assignments. Assignments, relatively lengthy assignment in terms of the number of questions, 1, 3, 6, 8, whatever the heck they are. There's a reasonable number of those. When I can get my computer to unwind here a little bit, we'll try to get going about that. I think I'll pause it and see if I can unwind it first. It's still going. There, I think now it's hit pop. Yeah, you guys have problems 1, 3, 6, 8, 10, 11, 13, 17, 20, 25. Fortunately, a lot of these questions are kind of similar, and you'll set up a format that you're going to use, so you can do some copying and pasting, at least kind of in regards to the format and how it's set up. So let's get started here. If I can get my Excel to get up and working, and we'll take a look at that. Problem 2, which is problem similar to your guys' problems 1 and 3. And maybe while this is going on, it says problem 2. Assume a corporation has earnings before depreciation and taxes of $100,000, depreciation of $40,000, and it's in a 40% tax bracket. And what we're really looking at here is what's the impact of depreciation. We oftentimes refer to it as non-cash expense. It certainly is an expense, but we call it a non-cash expense simply because we don't have to write a check to anybody, right? It shows up on our tax return, on our income statement on our income statement as being an expense, but we don't have to actually write a check to anybody. So, dang, well, I'm going to pause it again and see if I can get my Excel to go to work. Oh, maybe it is. There, yay. Hallelujah. If you're, don't mind me invoking a little religion, although it still says it's not responding and it's being really, really weird. You gotta love it. Maybe it's somebody playing an April Fool's joke on yours truly. Yeah, that would make everybody's day, except for that you guys have to sit and wait forever and a day for this darn thing to work properly. So maybe, just maybe. Let's see if we can make this thing bigger so y'all can see it. There we go. I think sheet 3. Here's how I would kind of set it up, and I've got I labeled mine. You could label it a little bit differently, but EBITDA is a term that they often use in the financial world. It just means earnings before interest, taxes, depreciation, and amortization. And as you can see, at the top of the one on your assignment, page 410 for number 1 and 2, it just says earnings before depreciation and taxes. So you could label it EBDT, I guess. I call it EBITDA because that's kind of a term that they use. So you set this up. So yeah, if you get this and you kind of copy, these 7 things right here, right? Copy that, and you'll use those probably in several others, and you can come back, of course, and copy it and paste it into there. And so we just set some deals up like number 2. It says assume a corporation has earnings before depreciation and taxes of $100,000. So certainly I can just change this to 100,000. Okay. It has depreciation of 40,000, so I can change this to 40,000. So I subtract my depreciation from my EBITDA, and I end up with $60,000 of earnings before taxes. Okay. Then I figure out my taxes, and I'm going to have to change this because this tax bracket is 40%. So I do have to make that change, right? At 40%. I'm going to have better change my formula up here too, because I've still got that 35. So I need to change this to 0.40. Okay. That looks right. 40 tax is 40% of 60,000. It should be 24,000. So my earnings after my taxes are $36,000. Okay, but then to calculate my cash flow, I can add back in my depreciation. So I got to deduct this from my, if you want to call it income, right? To create what is a taxable income, I calculate my taxes on that. Okay, and then I do add that back in to determine what my cash flow would be. Okay, and you know, that's a huge deal, you know, in terms of tax planning and those types of things. It does go on to say in C, it says, what if my depreciation changed from 40,000 to 20,000? Well, how easy is that? I've got all the formulas in there properly. I can just come and, you know, make that change. So my cash flow actually decreases, right, as my depreciation decreases. So kind of an interesting concept and important to know for financial management, of course. So then you guys have 3, and I think 3 is fairly similar. Assume a firm has earnings before depreciation and taxes of 200 grand. It has no depreciation, so you know, here it's asking you to do this, and what you might want to do is just take for 3, you know, make a separate column then. Okay, so you'd have the same, right? We'd have the same income up here of 100,000, maybe. Okay. But we'd have, you know, 0 depreciation. So you might want to just do 2 columns, and then you can compare the 2, right? So you'd have one with depreciation and one without cash flow, and see how that affects it. But you do the process the same way as what I just showed. So, okay, let's go take a look at what's your next problem. I think you had 1, 3. I think you have 6. And we started looking at the payback method. You guys have 6, and so I did 7, which is similar. And what it's asking you to do here, and you might set this up in different ways that works better for you, but this way seemed to work pretty well for me. So for 7, I had assume a $40,000 investment. So I put that up here just as a reference, right? So I said I had a $40,000 investment, and then I have investment options. I got investment X and investment Y, and what my paybacks are. And so, you know, I'm just using the data that we get right from the problem, and your guys's again would be quite similar. Okay, then I simply, again, you know, this would be really, and I probably should label it like payback X, and this one is payback Y. Okay, don't really need all those decimals. Okay. So all I have to do then is that each, okay, for my first one, it's just saying that here's what I paid and here's my cash flow from the first year. So, you know, I've only gotten back 6,000, so really there's 34,000 of the cost that I have yet to recoup, and that's all we're saying here. And so this one we have to do our formula, and it's really this plus, because I have this as a negative, so I just add those. Okay, and that's what gives me that answer. My next row, though, then this is what I have yet to recoup, and so then I reference this one. So it's simply this is equal to my 8,000 plus my 34. Okay, now I can actually just copy that down because my references will stay the same. Okay, so I copy that formula down, and away we go. Same thing for this side. I say this is equal to my $15,000 that I get, plus my negative, or the money that I originally invested. So I have that, and then this one is equal to my $20,000 plus what I have yet to recoup is the 25, and so there we are. Okay, so what this is telling us in our using a payback, and it's kind of interesting. It's one of those things you always want to kind of look at, but if you used only the payback method, right, you would assume that project Y was the better choice because you'd get your money back inside of just inside of 3 years. Okay, you'd get your money back inside of 3 years, and yet in 3 years under X you still have $17,000 yet to recoup, and so using that method you would pick payback Y. But then, as you can see, as it goes on, payback X continues to deliver some cash flow that's going to help you pay it back, and so in the end you might actually say that payback X. Okay, but in answer to the question, I think it says, which of the alternatives would you select under the payback method? I'd have to select Y. Okay, if I was only looking at it under the payback method, I have to select Y. Okay, then we move on to number 9, the short line railroad, and this is just another payback. Okay, and it's gonna be similar in this, in that we might look at. Let's see, do you guys have number 9? You guys have 8 and 10, and so this one I think is similar to 10, if I'm not mistaken. But if we go and look at 9, then, and again I just set it up. I've got years 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I put in my cash flows. I've got what my initial investment is up here is $140,000, and I put that in as a negative. I could probably make it like that. Okay, and it also says oh, it doesn't have a cost capital. I guess I just put that in myself because I was doing some other calculations. But I did those other calculations for a reason, and I'll tell you. So I set up my payback thing the same, right? So under the electric company versus the waterworks, I get $85,000 the first year. I get $25,000. You can see that what they've done is simply reversed the paybacks, right? Simply reversed the paybacks in the first 3 years, and then the rest of the years they're all the same. Okay, and so when you look at that, then in the third year for each, you've been fully paid back, and so you would assume, hey, this is a better deal, or these are similar deals in terms of the payback, because we get our payback in the 3 years. Yeah, let's take a look. This one I'm getting 85 grand the first year, and I'm only getting 30 grand the first year here, and so there is a time value to money. And how do we calculate that? How do we calculate that time value of money? And there's a couple ways to do it, okay? But we're going to be looking at, and so I'm going to go ahead and jump in, and it's why this might be confusing, and it's my way to demonstrate why it might be confusing. I've calculated a net present value of these cash flows, and it's why I put in a cost of capital, and I just made one up. It wasn't given to me, but 10% seems to be kind of consistent with what they've done. So if I say, what's my net present value of these cash flows? I get 85 grand the first year, and 25, 30, and then 10. Okay, and I'll show you how we do that. I just click on my formula deal like we have for so many others. It brought up the net present value. I'm gonna cancel it, and I'm gonna delete it so I can start all over again here for you. I'll click this. I'll come to, if you come under here to the financials, okay, and then it's going to be alphabetical. There's easier ways to do this, but I never like to do anything the easy way. It's just no fun. So I get net present value and rate, and plugged in my rate that I chose. This is just for comparison's sake, and my answer would be the same regardless. Not my dollar answer, but in terms of the answer, my narrative answer, it would be the same. Okay, and then the values, I can simply capture those. Okay, and then it tells me that my net present value of these cash flows is 150. Given a 10% cost of capital, is 157,000. My net present value, and actually I can't copy this over. I'm sorry, because of my reference. I could, if I made. I'll show you. If I made this static, I can hit F4. It puts the dollar signs in front of it. Okay, So my reference to that cell is static. My reference to the other cells will move correspondingly. I can just copy that over. So you can see that the net present value, the worth of this cash flow is 100. The current worth of this cash flow is 157,000. The current worth of this cash flow is 148,000. It's because I'm getting 85 grand coming in the first year. I don't get that 85 grand till the third year there. Okay, then we subtract our cost from that, and it gives us an idea of the difference. So certainly, if I were choosing, I would choose the electric one, right? Okay, so that's why it can be kind of confusing, and I think your guys' is similar. All right, you guys got 10, 11, and 13, and so I just did 9, which I think is kind of like your 10, 11, and I did 12 then, which I think is quite a bit like yours, because we start looking at internal rate of return. Easiest dang calculation that we get to make. Okay, it just does it for us. It's really cool. Okay, you got to enter in the stuff, but that's not too difficult. So I'm going to delete this just so we can kind of see. Remember that was 7%, so hopefully I can get that right. But in any event, here we are. Okay, so it tells us for 12, it says King's Department Store is contemplating the purchase of a new machine at a cost of $22,802. So I enter that in, and I put it in as a negative because that's what's leaving my pocket, right? Okay, and then I'm going to get $3,500 per cash flow for 9 years. Okay, I might want to do this just so I can. So you guys know you can start with the 1, 2. If you kind of highlight both of those and then grab this, it'll just keep counting for you. So bingo, I know that it's 9. On the other hand, I could put in 3,500 here. Okay. Oops, I hit one too many zeros. Okay. And same thing, I can just grab that and it'll copy that $3,500 down. So it makes it kind of easy. I know my numbers in and all that other stuff. Now, then for it says I got to calculate my internal rate of return, and gosh, it just doesn't get any easier than this. Okay, the book gives you a really long, complicated way to try to do that. Yeah, come on, let's move on to more important things and uses of our time, because good old Excel does this for us. Again, I clicked my financial category. Internal rate of return might be IRR. Wonderful. Okay. Values, guess. I'm not going to worry about guessing because it's just going to calculate it for me. Here's my values, starting with my investment, including my cash flows. That's all I have to put in. My investment, my cash flows in order. Okay, because my investment's going to come first, right? And then I'm going to have those cash flows, and I'm done. Okay, internal rate of return. The toughest thing is inputting, just typing in the numbers, right? Okay, I went ahead here and I did a net present value calculation. What it asks you, it says then, is this a reasonable investment if your cost of capital is 10%? Well, if my internal rate of return is only 7%, that doesn't reach my cost of capital. It's less than my cost of capital, so heck no, I don't want to do that, right? Okay. It does not ask me to do this, but I also did, because we're going to do some of these, I did the net present value calculation. Okay, and remember we did the net present value calculation back here. This is just simply going to confirm, it should confirm anyhow, what I have here. Okay, and the way to do that is, and I think I did it wrong here. Yeah, I did. Okay, and so I'm going to fix it. I'm going to start all over. I'm going to hit delete. Oops. Yep, there we go. Okay. I'm going to come up and do the net present value calculation. So I want to know what the net present value of this cash flow is. It's $3,500 a year for 9 years. Okay, so I'm going to go now to recently used because I've been using that net present value. Click on that. My rate is my cost of capital rate. I use that in this case. Net present value next to IRR is about the easiest calculation because, again, I capture those. And here we go. So my net present value of these is $3,500 per year for 9 years. My net present value is $20,156, but I have to invest $22,802 to get that. Yeah, I'm not going to do that, right? So in both cases, my IRR is less than my cost of capital. My net present value using my cost of capital says that my return would be less than my investment. I'm not going there, right? Alrighty. And you guys had 13, I think 13. Home security systems analyzing the purchase of manufacturing equipment that will cost 50 grand. The annual cash flows for the next 3 years will be, yeah, so that's similar then, exactly similar to what we just did for 13. So you should be able to do that. The nice thing, this one had a steady cash flow, and your guys's doesn't. The nice thing is it doesn't matter, right? You know, if I for example end up having $4,500 this first year, okay, it'll calculate it. Ooh, did that change? 3,500. Yeah, it did. It changed quite a bit, right? About $1,000 because it's in that first year. So yeah. Okay. So you can have unusual cash flows and it'll still work. So 13, we jump ahead. You guys went to 17, 20, and 25, and I did 18, and looks like I did 20, but 18 says this. It's kind of, I think, the same thing as what we've been doing. The Pan American Bottling Company, this will be like your 17, is considering the purchase of a new machine that would increase the speed of bottling and save money. I'm hoping that what they bottle is barley beverages, barley-based beverages, barley and malt. Okay, the net cost of this machine is 60 grand. The annual cash flows have the following projections. So let's again set it up. Okay, so my cost is 60 grand. Boom, I got years 1 through 5. Here's my cash flows, 23, 26, 29. I've entered that. I don't need to. Okay, if the cost of capital is 13%, so I just plug that in over here. You can put it there. It doesn't matter. What is the net present value of selecting a new machine? So it asks us to do that first. So again, what I want to do, let's delete that and say, what's my net present value? Let's click on that. My rate is my cost of capital, is what I use to calculate that. My value then, I got to click over there and I just capture those 5 years, is 74,356. I do have to subtract out of there then my investment in order to get my net present value. So this one here is equal to this, and because my investment's entered as a negative, I got to use my plus sign, plus my 60,000, right? So I have a net so that's a good investment then, right? If my cost of capital is 13% and I get this kind of cash flow, I want to do that, right? Just makes sense. And then the second is, what's the internal rate of return? Again, the easiest calculation for Excel, I think, in the history of the world is I click on my IRR, I hit OK, I highlight those values, left click and hold and release and go. Okay, I said it was a good deal because I'd have a net present value of 14,000. This should exceed my 13% cost of capital, and it's nearly 24% is my internal rate of return. So in fact it does. So it confirms in both cases, okay, that would be a good investment. And it confirms in both cases that would be a good investment. Okay, onward. You guys have 20. And so I did 20. 20 gets to be a little bit more complicated, maybe in terms of what it's asking, and so I think I set that one up. But Turner Video's going to invest $76,344. So again, I just set that up as my investment here. My cash flows are oops. 15, 17, 21, 25, 29,000. Okay. And for you guys, I did a little bit different, but I'm saying that my cost of capital is 12%. Okay. And then it says the internal rate of return is 11%. Okay. And actually did a MIRR, which is the hang on a second. I got to go look at the MIRR. That's assuming that you're investing it back, I believe, at the same rate. You guys don't have to do this, by the way. I just did it for fun. Returns the internal, considering both the cost of investment and the interest on the reinvestment of cash. Yeah, so it assumes that you're reinvesting the cash at the same rate, I believe, as what you're earning, and so it's kind of cool. Yeah, E8, there you go. Okay. Well, no, it assumes that you reinvested at the rate of your cost of capital then in that case. So, okay. In any event, your guys' internal rate is 11%, so you can just plug in the 11% there. Just ignore my ramblings there about the MIRR. I just kind of like doing that, and you guys might have to do that for the next one too. So here we go. Okay, so what's it asking? It says if the reinvestment assumption of the net present value method is used, what will be the total value of the inflows after 5 years? Okay, so if the reinvestment assumption of the net present value method is used, what will be the total value of the inflows after 5 years? Assume inflows. Okay, and then B, if the reinvestment assumption of the internal rate of return method is used, what will be the total value of the inflows after 5 years? So what it's saying is that this one's assuming that you're going to reinvest at the 12%, okay, and this one's assuming that you're going to reinvest at the 11%. So this one's assuming that you reinvest at basically your cost of capital, okay? And your guys' again is 10 and 11. I did 12 and 11 just so it kind of goofed you up. But this gets to be a little difficult, so that's why I kind of wanted to walk through it with you. Okay. So what it's saying is that I've got to calculate then if I get this kind of cash flow. In that first year, sure, I had this investment, but now I get this kind of cash flow. And what happens if I reinvest that, okay, for the remaining time frame? And you can see what I did is I set my years up backwards, and I had to get down to 0. So in this case, I'll be reinvesting this for 4 years, 3 years, 2 years, 1 year, and then this is what I get at the end, which is just what it is. So I'm looking for the future value then of my $15,000 reinvested for 4 years, okay, at 12%, okay. And in this case, I'm looking for this if I'm reinvesting it, my $15,000 cash flow for 4 years, but at 11%. So how do I set that up? Well, let's go do it. Okay. I can look at it and I can come here and I can say future value. Okay. My rate is my 12% in this case. And I'm going to hit my F4 after I do that because that'll put the dollar signs in there. My number of periods, and this is why I did this backwards. Okay, I got 4, 3, 2, 1 over here. Okay, and my present value, and I want to enter this as a negative, is the 15,000. Okay. Now that I should be able to just copy this down because the references will come over, but because I use the dollar signs for that 12%, okay, it should just bring it on down. So if I reinvest this money at my cost of capital, I will get this kind of return. Okay, be nice. It far exceeds my investment, right? But what happens if I can only reinvest it at the rate of return that this is giving me, basically? Okay, yeah, that gets to be a little bit more or a little bit less actually, because it's only 11%, so we assume it's going to be less. And the same thing though, we can just enter the formula as future value. Come to most recently used, future value, okay. My rate in this case is my 11%, hit my F4. Okay, my number of periods gives it to me there, and my present value, again, just enter that as a negative number there. Okay, and drag that down, and there we go. And as you might expect, I'm going to get a little bit more money that way. Okay, sorry about the ringing phone. Let me see if I can pause this while we're... Okay, so we end up with a number basically that we would expect, right? Okay, I'm going to pause this again for a second. And obviously, your guys' answers can be a little bit different because of the way, right? Um, Generally, is one investment assumption better than the other? You might have to look in the book. Is it better than to assume that you're going to be able to reinvest at your cost of capital, or is it better to assume that you might be able to invest at that project rate? Okay. Yeah, that's a good question. And you might be able to just think about it and come up with the answer too. So, okay, onward. You guys have number, what the heck? You guys got number 25? Yeah, you do. And I think I did part of 25 basically to show you how to set that up. Let me get to that here, hopefully. '25 just kind of talks it. It walks us through a little bit of different depreciation calculation, because depreciation it's one of the things that the government loves to mess with more than anything in terms of maybe promoting investment and doing those types of things. Generally speaking, the allowance of more depreciation up front encourages investment. And in fact, there's been a push here lately in Congress to maybe even go for full cost expensing, which would eliminate depreciation, and it would allow you to expense entirely the full cost of improvements. That's attractive to businesses because it lowers what they pay in taxes, right? If you're a farmer, for example, right now, if you go out and buy that new combine and you pay $350,000 for it, you probably depreciate it, let's say, over 10 years. And if you did it straight line, probably don't. You probably have some kind of modified accelerated cost recovery. But if you depreciated that over 10 years, it'd be $35,000 per year, roughly, right? And you would reduce your taxes, just like we showed on some of the examples that we had a little bit earlier. You'd reduce your taxable income by $35,000 a year, but you wouldn't change your cash flow in those 10 years. Now, imagine though, you'd be spreading out that reduction in income over that 10 years. Okay, if you don't make a lot of money, that would actually be advantageous. However, if you were able to, just think about that, if you were able to completely write off the $350,000, so let's say you had a good year and you made $400,000, okay, the difference is this: if you could fully cost that out or expense that out, you'd have $400,000 in income, right? You'd have a $350,000 deduction, so you'd pay taxes to Uncle Sam on only $50,000 of income. Pretty small amount of taxes. On the depreciation way, if you did the $35,000 per year like we were talking, you'd have $400,000 in income. You'd depreciate $35,000, so you deduct it by 35, so you would still pay taxes on $365,000 of income. Huge difference, right? And so you can see why that might motivate people to purchase things, get a little bit more active. Certainly it would cost the government maybe some money then in taxes, but they might make that up in terms of encouraging consumption by businesses especially. So yeah, it's like I said, it's one of those greatly debated items. So here we go. Here's how to set this one up. So you've got a purchase price here, and it's $380,000. You could put that as a negative. And so you just got to be careful on how your pluses and minuses show up on here. But it does say for this particular problem, number 25, it says that you pay $380,000 for this, and then you're going to receive $180,000 per year, okay, in earnings before depreciation, or your EBITDA, as I would call it, right? $180,000, and you're going to get that same amount for the next 4 years. So that's going to stay constant. So just enter that in there, right? Okay. Then it says calculate your depreciation, but use it based on the 3-year MACRs. MACR stands for Modified Accelerated Cost Recovery System. That's the fancy way of saying depreciation. It's the government's fancy way of saying depreciation. So you're going to depreciate it over the 3-year MACR schedule, which is actually 4 years. It sounds like a government thing. And so you get to depreciate it based on those percentages, right? So the first year you get to depreciate 0.333, the second year 0.445, the third year 0.148, and the last year just 0.074. Okay, and so what's that mean? Well, that means that's how much of this you get to write off. If you added those four things up, it would come to 1 or 100%, right? So it would come to 1. And so what you want to do then is the first year is 0.333. So I'm going to delete this. And for this year then, I'm going to say that this is equal to 0.333 times my purchase price. It's times my purchase price, not my income. That's a mistake that a lot of students have made in the past, but it's times my purchase price. Okay? And the next year then, it's 0.445 times my purchase price. Now, if you want to do a check at the end, you could run a total of these 4 years, and it should equal what your purchase price is, right? So my 4 years of depreciation here, I should completely write off the purchase price of this, and so this should be equal to, the total of those 4 should be equal to that $380,000. And then you just set each year up this same way, right? Just the way we showed you earlier. You've got your EBITDA, you got your depreciation, so here's your earnings before taxes. You calculate your taxes on that, which gives you an earnings after taxes, and then you add back in the depreciation. So I can just say this is equal to this, my depreciation, right? Okay, and do the math just like we did it on the other ones, and then I should end up with a positive cash flow, probably a positive cash flow, should be a positive cash flow, right? And ultimately I might end up even with the total of that cash flow down there. So, okay, so it shouldn't be that difficult to fill out. The main thing is making sure that you take your depreciation. It's going to differ every year. It's not the same. It's 33% basically this year. This year it's about 45%, so that my depreciation's higher. Then it gets lower, and then much lower in this final year. So, okay, so my cash flows will vary accordingly. That should be it for the for the problems. Okay, let's spend a little time talking about the project. I've had 3 outlines put in. Each had some pluses, and I'm going to boldly talk about maybe some of the minuses on the outlines that I saw. For those of you that submitted them, think of this as your little bit of feedback, and you're welcome to go back and make some changes, additions, or whatnot. Okay. First one that I looked at, it was a nice outline. It was set up properly like I had requested. I would say this, that the financial data was simply generic. It was basically what I asked for in the finding financial information. Okay, that's not what I'm looking for the final project. Okay, I said that in the finding financial information because I just wanted you guys to know how to go and look for financial information. Okay. Might you use that? Well, yeah, sort of, kind of, and I'll try to give you some examples here if I can get my computer working. I'm going to go to Morningstar. I'm going to show you. One person has actually come in a couple times, and so keep that in mind that I'm really open to talking about these things. I love analyzing companies. I mean, I just dig it. Okay, and so if you come in and you want to sit and talk about your company, if you want to email me, if you want to give me a call and say, God, what is it about this company that we need to analyze and find out what's strange or unique or any of those things, I love it. I'm going to pause while I try to bring up my Morningstar. Golly, come on. Okay, so I was talking about the generic financial data, and where do we want to go from there? I mean, what am I looking for, right? And I know that's what you guys are asking, and I wish I could tell you that it's the exact same thing for each company, but I can't. It's going to be up to you guys maybe to find it out. I'm happy to help you at the front end and let me demonstrate. So I was talking to one of your students, fellow students, about his particular project, which is Brew, B-R-E-W. Imagine that. Hard to believe I like that one, right? Which is a craft brew alliance, and it's a conglomeration of about 4 or 5 different breweries that have gone together and formed a company, right? Yeah, we looking at it here again at Morningstar. So I typed in the brew, and this is kind of interesting, right? I get my quote, and I come down here and I start looking at stuff, and here's some cool stuff that it gives us. Okay, it says price to earnings, those types of things, price to book, price to sales. Those you might find compelling. It kind of depends. These are there's definitely some interesting things here. The price to earnings kind of surprises me that it's a way higher price. Okay, that just tells me that the market's expecting the stock to grow or that its earnings to grow, right? Expecting is my guess. Okay, price to book, it's selling at quite a bit less than the industry average. So that's kind of interesting, meaning that it actually has pretty good assets, but it's probably not being priced well because doesn't have a lot of earnings, which we'll see. Price to sales might be kind of the same thing. What intrigued me, and of course the net income growth is huge, right? I think what leads to that, though, is the things that I'm looking at down here. The operating margin, 2.9% versus a 29.4% on the industry average. Net margin, 1.5, and net margin is your net profit divided by your sales. Okay, 1.5 versus 17.9. ROA, return on assets, 1.8 to 7.5, and ROE 2.7 to 17.8. Ooh, okay. These are all negatives, obviously, that the company has, and my guess is that's what leads to some of this stuff. So how do I go and kind of check that? Well, I want to, my guess is what leads to those types of things is there's something weird in the financials that I kind of want to take a look at. And in this case, by the way, there's some competitors that are craft brewers that are also public, and I think we found that some of those competitors were Sam Adams, Boston Brewing Company it is, which brews Sam Adams, and their ticker symbol SAM, and also United Beverage or United Brewing, I think is the name of the other one. But anyhow, first I want to start and look up financials here for the Craft Brew Alliance. So I'm going to click on financials here. I'm still on my Morningstar. That's going to take me to a little bit more detailed look at the financials for the company. I'll tell you what's concerning me. When I looked at that, just on the front edge, I said, wow, that's a really low ROA and a really low ROE compared to its competitors. And I kind of want to know why, and my suspicion then is that probably with the net margins, it even says that my net margins are lower, that probably the cost of goods sold or my operating costs, one of the two, are higher than the industry average. Okay, and so I start when I do the financials. It's great. I can do 5 years. I can change this. I can change some of these things if I want to look at it over different time frames. I can also change it from percentages to dollars. So I can choose all kinds of ways to report this. I like the percentages now. That's what I have it set up on for now, for this particular, the way I'm looking at it. Okay, and the first thing I want to look at is that, my revenue, of course, is 100%, but my cost of revenue then, or my cost of goods sold, right, is ranging at about 70%. I don't know a heck of a lot about beer, but I can tell you that it seems like the actual cost of producing beer ought to be less than that. Okay, and the gross profit. So the gross profit here is 29, 28, 29, 30. Okay, so it's not a real big number, I don't think. But how do I check? Well, I might go and look at that competitor, right? And SAM, or Boston Beer Company, was one competitor. So I'm going to click on that, and let's hope that SAM will come up, and I think it'll take me right to that same page so I can make a really nice comparison. Oh, look at that. Cost of goods sold for SAM, it's come up a little bit in the last few years. They were really good here, only 45%. They're up to 48%. But, their gross profit's 50% versus 30% for, holy cow. Ouch. Okay. Now, here's the important thing. I did that little bit of footwork kind of along with the student. We sat and talked about that, and I think that's, that's telling. I probably should also compare my operating expenses from one to the other, okay, and see if that's telling. But first, I'm sticking on that gross profit thing, and here's the thing. Here's what I want to know is why. Okay, I want to know the why. So we found something that's really different about this company as compared to competitors. And again, it might not be compared to competitors. It might just be something that's in the company that you're looking at. Okay, but in any event, this time it's something that's compared to the competitors. And so I looked at that and I said, wow, you got to find that out. You got to tell me. Okay. You got to tell me why your company's gross profit is so low. You got to tell me why their cost of goods are so high. You might want to look at their operating expenses too, and those other comparisons that you might make. Okay, you might want to go look at there was one other public craft brew company. Okay, and I want to take you and show you one place to kind of find that, which is really cool too, that Morningstar gives us. Okay, and what I told the student too, and this is really true, and I'll tell you guys, the toughest, I think the most difficult company to analyze is going to be the one that has growth, steady profit margins. They're just doing good year after year. They make money. Might be the best kind of company to invest in, but in terms of for this project, it might be one of the more difficult ones to actually analyze, because there's not a big thing like that just jumps out at you, right? So kind of look for those things that jump out at you, and if you have a problem, or if you can't, if you can't see something, give me a holler. Either come and visit if you're local, send me an email, come and talk to me. Okay, I'd like to see, what I didn't see in any of the 3 outlines that have been submitted so far was any information that took me in that direction. Okay, it was generic. One had no financial data, okay, at all. And kind of saying, well, I'm still busy looking for that. Well, that's fine, but that's what I want your report to be on. So I want you starting to look at this. I want you following it. I kind of want you following the news of your company, even a little bit day to day. You might go look at it and see, because there might be some things that come up here real recent, that you want to look at that are of major concern. It's also its annual. For companies that had a year end that was the fiscal year end, or 12/31, annual reports are just starting to come out. In fact, we found that with Brew. We had to look a couple different places to actually find its year-end report for 12/14. The company's website didn't even have it posted yet, but we could find it otherwise. So we're kind of right in that in-between time where those annual statements are starting to come out. So, okay, I'm babbling a little bit because I'm waiting for my computer to respond here. So. Okay, so one had generic financial data, the one had no financial data. The last one wasn't really an outline, and again, it had already kind of written the first couple parts of the paper, and it got to the financials, and it gave me the finding financial information that I asked for the prior time. Okay, that's a paragraph. Okay, and if you put that paragraph into your final paper, that's maybe okay, but that's a sure way to get a D on the paper, or worse. Okay, you got to do some more digging. You got to start looking at these things. Okay, we looked at the competitors, and most of you guys will have that, and gosh, Morningstar does a nice job. It comes down here and it says competitors for Brew. I looked at these are all big ones, and yeah, they're kind of competitors, but their financials are going to be a lot different. So, but it says up here, it says click on more. Okay, so a lot of you, I actually talk about the industry, the competitors in your industry, right? I want you to spend a little bit of time. Well, here we go. Here's the biggest. Anheuser-Busch has got a market cap of almost $200 billion. It's hard to believe we drink that much beer. And you come down here, Sapporo, you could look that up. That's a Japanese company, and so I'm not sure if the comparisons there would be as relevant. And then you've got Boston Beer, and then you've also got United Breweries Company. And we didn't look at United Breweries, but that'd be kind of interesting. Gives us, price to earnings ratio, few different things like that. It's about the same size as Boston Beer. 5-year revenue growth, a little smaller, but its operating margins are a little bit better. Kind of cool, huh? Price to earnings, yeah, a little lower. Might have to go take a look at that one. So I have to find the ticker symbol on it, but I'm guessing if I clicked on this, it looks looking like it would let me click on it. Then I can make those comparisons. So again, start digging into this. I'm giving you a month, right? Find some stuff about your company, and I'll try to pick on other companies as we go along, maybe ones that you guys have picked, maybe just some other ones out of the blue. Find some stuff about that company that might be interesting, that might be kind of unique, that might drive the value. When I looked at this one, their margins are really low. But what if I thought, what if I'm reading through their annual report and it's telling me that that's the thing management understands, or that, the margins are really low because they've been investing a lot in building the company and growing the company, and so they've been giving up margins, right? Their costs are higher because their cost of goods sold are higher because they're a smaller company. I don't know what the reasons are. You need to find that out. But if I thought they could fix that, that might make for a big move in the stock, right? Okay, those things are interesting. And I'll give you an example of a company that's got horrible margins but keeps growing and growing like crazy, and it's Amazon. Amazon invests every stinking dollar back into the company, so they've shown virtually no profit for years, and yet it's growing like crazy, right? It's becoming the behemoth, right? If I had to bet, in maybe 10 years or so, it's going to surpass Walmart as the biggest retailer in the world. Lots of things are going to happen probably, and maybe a competitor will step up and knock Amazon off its perch. I have no idea, but there's a company that has very low margins, so it doesn't mean it's a bad thing. But at some point in time, maybe Amazon's going to turn that around and start managing for more profit and less growth. At some point in time, they might have to, right? If your growth slows, then what do? Well, then you got to turn on the profit thing a little bit, get some cash coming in. So those are things to look at, right? Look at your company. Again, talk to me about it, okay? If you don't see things, that kind of jump out at you that you find interesting, I don't want to guide your paper necessarily either. I'd like you to find things that are interesting. But I also know that, a lot of times you haven't had a lot of experience there. So if that's the case, talk to me about it, and we'll find some things that you need to do some research and tell me about. That's it for the day. I think I've babbled enough about Project 2. So have a good break. We get Friday off. Those of us that are here, I guess distance classes don't really get a day off, but have a good break if you're traveling.